Welcome to Bloomberg Markets. I'm Scarlett Fu. On this shortened holiday week in the U.S., markets are reacting to Trump's pick to lead the U.S. Treasury. So let's show you what's going on here right now, because stocks did open higher, as did bonds, but you could see that they've given up a lot of their gains, and the S&P 500 now unchanged. But you look at small caps, that is flying right now, with the Russell 2000 up 1.6%. All 11 industry groups are in the green at the moment, led by cyclicals like consumer discretionary and financials. You have the 10-year yield moving down 10 basis points, so moving further away from that 4.4% level that we were kind of stuck at the last week. And the dollar is weaker as well, falling against all G10 currencies. Bloomberg Dollar Index losing 0.4% at the moment. Now, as mentioned, our big story today is Wall Street cheering after the Trump transition team announced Scott Bessent to be nominated to be the next Treasury Secretary. Earlier, David Bianco spoke to Bloomberg about how Bessent colors market outlook.
With Bessent, markets, not just markets, the equity side has been very excited about Trump ever since the win, but this is good news for the bond market. The Secretary of Treasury to come is concerned about the deficit, so that's welcome news.
For more on how Wall Street is reacting to the choice of Scott Bessent, we're joined now by JPMorgan Managing Director and Portfolio Manager Priya Misra. Priya, thank you so much for taking the time to speak with us. I'm a little confused, I have to say, as to why the bond market sees Scott Bessent as such a positive pick. Yes, he's seen as more moderate on tariffs. That is the thinking. But the reporting also shows that commitment to Trump's tariffs was a key deciding factor when the president-elect made his pick.
I think so. It's a very fair point that I think the president-elect does want tariffs, and I think the Treasury Secretary is going to help implement it. I think the question is how, and if it's a phased-in approach, if it's a negotiating tool. I think the market doesn't see it as tariffs go in place and the world has to adjust, but more that it's a process. But I think what the market's looking at more is on the deficit front. I think for the last month and a half, interest rates have risen significantly. We've essentially priced in a deficit trajectory, which is looking worse every year, as the 2017 tax cuts were likely to get extended, and then the idea of more tax cuts. And we know Scott Bessent's view has been that deficits are a problem, and it's not so much tax collection, it's much more, on the spending front. So you combine that with the DOGE, or this idea that waste might be cut back. I think the bond market is taking a step back, and the move over the last month and a half, which has been about pricing in higher term premium, or I need to get paid more by the U.S. Treasury if I'm lending them money for 10 years over 2 years, that spread is starting to come down as we realize that the new Treasury Secretary, if confirmed, is likely to be focused on fiscal sustainability. Not getting the deficit down to zero, but just getting it to a more sustainable 3% level is sustainable.
And that makes sense, given that we've seen equities give up a lot of their gains, but you see treasuries holding on to their advances as well. So progress on the deficit front as one reason to continue to be positive. Is the sell-off then in treasuries over for now, Priya? The 10-year is now, less likely to go to 4.5% or 5% as a result of all this?
So, in our view, to take a step back we've sort of gone from one end of the spectrum to another. I think the 10-year in a soft landing is likely to be between, 3.75 and 4.25. Or I can give you an even tighter range, 4 to 4.25. That's sort of the range consistent with a Fed that continues to cut rates, close to a neutral. Now, we don't know. We all debate neutral. Somewhere in the 3.5% range, we think would be fair for neutral. If the Fed continues to cut, the economy is slowing down but stays in a soft landing, that's sort of the rate range that I think makes sense. So when we were getting close to 4.5, we were actually saying that's an opportunity. So to your point, is the move over? I think we get back to 4.5, we'd be looking to take advantage of. We get below 4%, then you need to see data to corroborate it. Because ultimately, interest rates are about the fundamentals of the data. And I think we're in a soft landing. We have the payroll report coming up next week, so we'll see. But I think the economy is slowing, but still above trend or close to trend. And the Fed's still cutting rates. So it's the reaction functions, the economic data. I think the 10 years should really be in this narrow range. So it's all about you're getting yield from fixed income, you're getting the hedging property. If the economy slows down more, I think the Fed's telling us that they're going to cut more, and that's the advantage of owning duration. But I think, we're sort of in a very fair range for the 10-year here.
Got it. Scott Bessent has said that the current Treasury Secretary, Janet Yellen, has overutilized T-bills to fund the government. Do you see Bessent changing the mix to reduce the shares of bills from the current, I think it's around 22%?
Sure. So the TBAC, or the Treasury Borrowing Committee, has a range in mind of, about a 15% cap of where bills should be as a share of total debt outstanding. And the Borrowing Committee has said that the Treasury can deviate depending on demand, supply, depending on needs. I would argue actually right now, given $7 trillion sitting in money market funds, given the shape of the yield curve, there's actually more demand for the front end. So right now, I actually think Treasury issuance makes sense. But, where the Treasury issues tends to be a subject that the Treasury studies, market participants have a view, primary dealers have a view, the buy side tends to have a view on this. I think it's going to be, and we have auctions every week to look at where that demand comes from. I would argue demand's less in the long end right now, so I think Treasury should continue to focus in the 0 to 5 year. But if that changes, if you find because of US exceptionalism continuing or the dollar, if more demand comes into the long end, I think Treasury should always evaluate lowest cost to taxpayer. And as a taxpayer, I think it would make sense for them to shift policy depending on where the demand is. Right now, I do think it's the front end, so I don't think Treasury should be changing or is likely to change that mix anytime soon.
Got it. And you mentioned the dollar. We know Scott Bessent spoke with the Wall Street Journal saying his priority is to deliver on the various tax pledges, cut spending, and also maintain the status of the U.S. dollar as the world's reserve currency. Keeping in mind that the dollar is weaker today, does that generally mean a stronger or weaker U.S. dollar?
We think stronger U.S. dollar because of U.S. exceptionalism. If we look at the policy, the entire policy mix, whether it's trade, fiscal, deregulation, that's all positive for the U.S., sometimes at the expense of the rest of the world. So I think it is a stronger U.S. scenario. The reason we've moved today is really positioning into Friday was one of, it had strengthened a lot. And so are people just taking some profits there? I think that's what we're seeing, more consolidation with the dollar. But I do think that a stronger dollar, given the rest of the world, given the policy mix, is a likely outcome. And as long as the Fed stays credible, independent, and there's no intervention, which I think the U.S. is too large a country, I think the dollar should be stronger.
Fantastic stuff. JPMorgan Managing Director and Portfolio Manager Priya Misra joining us today. Thank you so much. All right, coming up, Macy's will delay the release of its third quarter earnings report, and this after an internal investigation found wrongdoing within the company. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. It's time now for the stock of the hour, along with some other equity movers, and we check in now with Abigail Doolittle.
In fact, yes, Scarlett, let's take a look at some of the midday movers. It's a little bit later than usual, but you can see lots of stocks here in the retail space on the move. As you were just mentioning, Macy's down 3.5%. What really stands out here is that the decline is not more, given the fact that there is an ex-employee who basically intentionally screwed up the accounting around small package deliveries to the tune of $154 million, as much as $154 million. And it's been occurring since 2021. The company found these errors going back when they were preparing for the quarter. In fact, they've had to delay their earnings report to December 11th because of this. But because the stock is already down so much on the year, and the real issue, since this isn't going into their cash management when they don't think it affected vendors, is same-store sales comp. So you can see lots of strength, though, for some of the other retailers, and Bath & Body Works in particular. Let's take a look at a bigger winner, though, and that is Kodak. It's hard to believe that they're even still around, but that is the case, and shares are soaring today, up 26% on the possibility that they are going to potentially divest their retirement plan. That would be a good thing, and it ranges closer to almost $1 billion. So investors seem to think that's that unlocking value of some sort. This stock is already up more than 60% on the year. And then finally, Amazon, well, they are continuing their work on chips around data centers that would compete with NVIDIA. Today up 1.2%. And Scarlett, this, of course, also has to do with the start of the unofficial start, I should say, of the holiday shopping season on Friday, Black Friday.
All right. And of course, we'll be there for all your coverage on Black Friday as well. Abigail, thank you so much. Now turning to the most read story on the Bloomberg this hour, the price of tuition at Bethel University in St. Paul, Minnesota, currently about $44,000. Next year, it'll be close to half of that, around $25,000. And this is part of a trend as dozens of small colleges colleges across the U.S. slash prices in what's being called tuition resets. For more on this, we're joined by Bloomberg News Deputy Managing Editor of Personal Finance and Wealth, Craig Giammona. Craig, to be clear, elite colleges like the Ivies are still charging up to $100,000 a year. So we're talking about schools that don't have the name recognition that a Harvard or a Yale does.
Yeah, that's right. These are not the most well-known schools, but we are seeing this as an increasingly popular trend across the U.S. Schools that need to find ways to stand out. Enrollment is down. They're having a hard time attracting students. So they're looking to these tuition resets, as they call them, to get more people in the door. But these are not your brand name schools.
So we mentioned Bethel University. There's a couple of other ones. And the strategy of tuition resets, is it working in the short term? I mean, is Bethel seeing more interest?
They say it is. They say they're signing up more students. They've got more students coming to networking events. There's a school in Virginia where the president went on billboards announcing this. These schools often cater to local students. They're competing maybe with the state school. These are kids that are probably staying in the area. So they have gotten attention. It's definitely working as a marketing tool. They're getting more people in the door. I mean, whether this is a long-term strategy, whether they can stay viable, deep into the future with this, that remains to be seen. But they are saying in the short term it's working.
Yeah, there is Mills College, which is an all-women's school in Oakland, California, that also cut its tuition, but a couple of years later it got absorbed into Northeastern.
If you talk to experts, this isn't the best sign, right? I mean, you can use a comparison to maybe the retail world or when things are going on sale. What does that say about the strength of the brand? So these schools, again, will say in the short term it's working. We're doing this because we want pricing to be more transparent. One of the big stats that is hard to believe is that something like 20% of kids actually pay full price across the U.S. There's a lot of aid. So what they're saying is, look, these prices don't need to be so high. We want to get real transparent pricing, and it is working on a marketing level. Like I said, are they doing it from a place of strength? I mean, Harvard, Penn, Dartmouth, these places are not cutting tuition. They're flooded with applications. Everybody still wants to go to the Ivies and are willing to pay.
Right. I mean, so for as much as people complain about university prices being too high, when they're lower than what people are used to, then they get a little bit suspicious as well. There's one school, Minerva University, which charges an all-in price of about $50,000. But it's different because the classes are online. It sounds like there's no physical infrastructure like classrooms or dining halls or libraries.
It's a really interesting school. They basically created a school from scratch, new model. They wanted to go at cost. They wanted to take out some of the things that drive up the cost. There's no, there's no fancy dorms. They don't have a lot of the frills that we think of at the elite private schools. And it's a $50K all-in price. We had the president in the office here talking to him. He said he actually thinks the price has hurt them because, they don't have great name recognition either. They're new. They're trying to sort of establish their brand. And people are looking at it just like we look at wine, food, anything else and say, if it's more expensive, it's better. I mean, that's a very common thing, right? When we go shopping, we all think that. And what he's saying is that we did all this stuff to keep the price down, and it's hurting us in the marketplace because people think it's cheaper, it must be worse. So very interesting psychologically how you sort of appeal to families and students.
And I guess the big backdrop here as well is that there is a demographic cliff coming where a lot of these schools need to get ready, brace themselves for years in which there aren't enough students for the colleges that are out there.
That's right. I mean, there's been a lot of school closures across the U.S. Often these small religious schools are closing, these places in rural America that can't hold on anymore. State schools have done pretty well because of the value proposition. The elite schools continue to do well, but there's not enough students. Increasingly young men are not going to college. There's some interesting numbers there. So as a business, higher education has an issue as far as the cost, getting people in the door. And this is a super interesting piece of that world as these schools try to navigate that.
All right. Fantastic story there. Craig Giammona's team, Bloomberg's Craig Giammona. He is Deputy Managing Editor of Personal Finance and Wealth. Thank you. All right. Coming up, we've got the future of office real estate. Our next guest says that not all cities are created equal. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. Many commercial real estate properties are at high risk of default heading into 2025. Now, for more on the commercial real estate market, I want to bring in founder and CEO of United Capital, John Devaney. And John, your firm is one of the largest dealers of securitized products in the U.S., so things like CMBS, ABS, and you've been calling for a continued implosion in office building collateral in major U.S. cities. Before we get to which cities those are, why is that with interest rates now heading lower and transactions in the space actually picking up?
Yeah, sure thing. Well, one of the biggest forces for sure are the 10-year Treasury moving from 2% to 4.5%. Just that alone made the appraisals from 10 years ago at 4.5 cap rate go to 6.5 cap rate today. Right there, even for the best properties, that winds up being a decline of about 25 to 30%. These are huge headwinds for all these companies to try to refinance. Inflation made all the property taxes and expenses go up. It makes NOI go down. So inflation, unfortunately, made the buildings go down as well. We don't need to get into work at home. Okay, obviously work at home is a big issue for the whole country that has led to a lower occupancy.
Yeah.
Some of the observations that I have that are the trickiest for me to try to analyze and forecast into the future are what I have now deemed, for about 15 of these cities that I could talk about, what I consider to be flawed social policies.
Wait, so you're talking about policies that the mayor, for instance, implemented and prevents the downtowns from thriving?
Yeah, exactly. So in my opinion, that a lot of these flawed social policies, they are open-air drug markets, giving out needles for heroin, letting fentanyl and opioids trade. The police look the other way. There's defunding the police. There was the big issue in California and San Francisco. They reversed it, but there was $9.50 or less, you didn't get a ticket, leading to smash and grabs of shoplifting. All the pharmacies were closing. So the homeless problem has become a huge issue as well. And so some of these policies in these cities, in my opinion, I've spent so much time thinking about this. Los Angeles, Oakland, San Francisco, Philadelphia, St. Louis, Chicago.
Yes, but you have new local governments in some of these cities. San Francisco, for instance, elected a new mayor in November. That doesn't affect your outlook?
No, it's going from implosion to now glimmers of hope. But these other forces change commercial real estate. These things are making it so many of the employers, they just simply are not renewing leases because it's the crime and the blight and the cities, the fabric of society in some of these city centers, like Philadelphia, it looks like a war zone there. Nobody is renewing any leases there. So they've got to clean up these cities. It's like, so the outlook as well, for my opinion, in these cities, I think that the municipal debt in a lot of these cities should be put on a negative outlook. It's just because all the tax revenues are going down. These cities are in trouble.
Do you see demand from your clients based on which cities
they won't touch this stuff with this somebody else's 10-foot pole. You have no idea.
So they're saying, keep me away from it?
Get me away from the conduit deals and these SASB deals that have anything to do with these cities. It's just too hard to call. For example, there are buildings like 1500 Market Street in Philadelphia. I mean, it's like a several hundred million mortgage. It's like they're going to be lucky to sell this thing for 50 a foot, which is going to be like 50 million bucks. It's going to lose 80%.
So, John, let's talk about not just office buildings, but a lot of these office buildings are mixed-use buildings as well, and they have commercial businesses too. And some of them are malls as well. So let's talk about the state of malls, because there seems to be a bifurcation between the strong performers who are in prime locations and have an appealing tenant mix or the right tenant mix, and those that lack those traits completely. How is that playing out in what you're seeing?
That's a great question. So malls are another big topic. They got hit bad by COVID. They all closed. They suffered lots of bankruptcies and inlines and bankruptcies of the anchors. Okay, the A malls are better than ever. Okay, they still got hit with the fixed rate malls, with interest rates going up, and some of those guys are going to put some money into refi, okay? It's the B malls.
Right.
And it's Brookfield, okay? They are not committed. They had 115 malls. They're going to give a third of them back. They've only given back 10 or 12 of them so far, but they've got 30 more to go. They're not committed to the mall industry. Now, there's a lot of value.
And that's a bad sign.
Well, it's kind of touch and go, because with anything, there's opportunity within a changing marketplace. And to be honest with you, if you ask me to bet on one of these B malls or an office, I'm taking the B mall all day long, because the debt yields are 8 or 9% on many of these things, and the debt yields on the bad offices are 4 or 5 or negative.
I see.
Yeah, so there's cash flow there to let the malls get extended. And
John, before we let you go, I know there's something that you're in town for a specific reason. It's one of your passion projects. It's the premiere of a movie, City of Dreams, which stars Tim Robbins and Mira Sorvino. You helped fund this film. What is it about this film that drove your involvement? Okay,
so I was super touched by this film. I saw the film and I really cried. And I don't really cry in movies.
What is it about?
It's about a young boy who was trafficked across the Mexican border. It's based on a true story. He was held captive in a sweatshop with some other children, and it's about the courage that this young boy had. He fought back against the captors and freed himself and the other children. And child trafficking in the United States is up right now in 6 or 7 years, 400%. We're talking about hundreds and hundreds of thousands of kids. So I met the director, I talked to him, I cried, I talked to him till 2 in the morning. They were looking for $5 or $6 million to make sure it had a worldwide and a very big release. And the next morning I called him, I said, hey, I'll give you the money. Now that, I've realized all these kids are in trouble and so many of them, were trafficked across the border and given to these bad guys, that now I'm using my voice along with some other really big leaders like Tony Robbins, Vivek Ramaswamy, Mira Sorvino. Lots of folks are sort of joining into our group.
Shining a light on this.
And trying to raise awareness, and it's the right thing to do.
And just very quickly, you have another film that you're involved in, The Prince, starring Nick Cage and Giancarlo Esposito. Is that tied to this subject as well, or no?
That film is about wealth, power, and politics. And frankly, it's a lot about addiction. I lost my brother to crack cocaine addiction when I was 25, and he was 26, and I'm sober. And I really was touched by that film, and that's going to be coming out in May. And, we're really excited to have my new film company backing a number of these films that are going to incite conversation and that have some kind of purpose and meaning.
And are tied very much to your passions. John, thank you so much. John Devaney is founder and CEO of United Capital. Wide-ranging conversation there. All right, I'm Scarlett Fu, and that does it for Bloomberg Markets. We're looking at an S&P 500 currently up by 0.1%, while the Russell 2000 gaining 1.7%. This is Bloomberg.